The big thing for the market, of course, as Manus and I have been kicked off the show, is going to be what Jay Powell says. Do you think we'll get a hint on where he sees inflation going?
Well, I think we're hoping to get some sort of hints as to where their fundamental review is going. And there's a lot of expectations around that. I think they're well priced in now that they're going to move towards some type of average inflation targeting. That seems to be priced into markets already. So I don't anticipate a huge amount of surprise. I think actually what would be more newsworthy this week is if he disappointed markets and didn't give us any sort of hints about where that was going. As we saw in the last minutes, there was some disappointment about that.
Well, that's where we started, the satire piece in the Business Week. Marvin, good morning. Good to see you as always. Just do whatever the bond market says. It's bigger. It's better educated. It's sharper. It's a sharper dresser than both of us. They read the minutes. Apparently, the bond market read the minutes. But herein lies the angst, isn't it? Who is pushing the Fed? Is it the explosion in equity valuations, or is it that rally that you saw in the bond market last week?
I think it's really their focus on getting the economy back on track and getting inflation to target and showing to people that they're symmetric around that target because they've been undershooting that target for years now. And that's what bond markets are reflecting. And to the point that equities are at highs, remember that's because the discount rate has fallen. If you actually look at the equity risk premium, the amount of premium priced into equities over the bond market, it's actually a pretty high level. So it's not, the stocks are not as expensive as people think. It's that bonds are super expensive, and they're reacting to the Fed saying, we're going to keep policy easy for a long time because we've been undershooting inflation for so long, and we face a huge economic challenge right now.
I'm getting the sense that a lot of this, from what you're saying, Marvin, is already priced in. Standard Chartered this morning has a note out saying the dollar has another 5% to fall from here. Potentially, I guess, headwinds with U.S.-China trade war. On top of that, the U.S. election. Where do you see the dollar from here on out?
So I think we have a very different view. We do think that this generalized consensus that's developing around a weaker dollar is overdone. At the end of the day, the U.S. still has much sounder fundamentals than most other economies, regardless of what happens with the election. We saw very clearly back in March that the safe haven of choice is the dollar. Nothing is preferred to the dollar, not gold, not JGBs, not bunds. And we also see that if you look at where returns from capital are going to come, where growth is going to come from, the U.S. seems to be outperforming other G10 economies. So we're not really in that camp. Now, that said, I do think that you have to respect that there is a market consensus around a weaker dollar right now. The U.S. election does pose some risks to returns to capital outlook in the United States. And all of those things do mean that there are some short-term risks to the dollar, but it's really difficult for me to see this developing into a trend.
Okay, so those you say probably pass with the political outcome. Marvin, the options market in the euro, if we look at the run that the euro has had, 8 weeks in a row, I know we took a little bit back last week. If I look at that kind of momentum, and I just want to understand this, the dollar potentially is being priced down because of the fiscal risk from Biden, and yet the euro is bid on the fiscal floor that the deal has done. So the fiscal narrative is seen in two very different ways from the dollar and in the euro. Do you see and believe in that differential?
So, look, there is one important difference with the fiscal package in Europe, which is that this was done at an EU level on an unprecedented fashion. It is not a Hamiltonian moment, as everybody likes to call it, right? Hamilton actually guaranteed the debt of the state. They're not doing that, right? But it is a step in that direction, and it does increase the probability of Europe actually finally achieving fiscal union, which would be a huge step that would eliminate this background risk of EMU breaking up. And so that was really important, and that's valuable. I think it's probably priced that in at this point. Markets seem to think there's more to go. I disagree, but that's why there's a market.